Hello, this is Gerard with another lesson on taxation. On this video, I'm going to be talking about depreciation expense and how to claim it as tax deduction. So let's begin with the novice question, which is, what is depreciation? Depreciation is the accounting method of allocating the cost of tangible or physical assets over its useful life or life expectancy. Simply put, depreciation represents how much of an asset's value has been used up. Some key terminologies related to depreciation are as follows. So depreciable cost is the cost of an asset that can be depreciated over time. It is equal to acquisition cost of the asset. This may include all other incidental costs related to preparing the asset for its intended use, minus its estimated salvage value at the end of its useful life. Next would be salvage value, is the estimated resale value of an asset at the end of its useful life. Lastly, useful life is the estimated lifespan of a depreciable asset during which it can be expected to contribute to business operations. The depreciation method acceptable for tax purposes could be straight line method, declining balance method, sum of the years method, and any other method as prescribed by the Secretary of Finance upon recommendation of the Commissioner of BIR. I'll be demonstrating all of these depreciation methods in a separate video. Initially, the taxpayer has the option to choose whichever depreciation method would be most appropriate. But subsequently, if the taxpayer would decide to change depreciation methods, they would need approval from the BIR. Now, there are instances wherein certain depreciable assets are reappraised, particularly if the entity is using revaluation model under PIS number 16. Now, the resulting depreciation of the revaluation surplus is not allowed as a tax deduction, as this does not represent actual cost of such asset. In the same way, impairment recognized in the accounting records under PIS number 36 are disallowed. Such impairment could only be claimed as deduction when the asset is disposed of or retired. Now, another key thing to know is Revenue Regulation 12-2012, which is the deductibility of depreciation expense as it relates to purchase of vehicles and other expenses related thereto and input taxes allowed. In this revenue regulation, the depreciation expense of the taxpayer with regards to purchase of passenger vehicles provides the limit of deductibility, along with the disallowance of input taxes in relation to disallowed expenses. It is not automatically presumed that purchase of vehicles is directly related or used in the business. In relation thereto, such rules should be followed. First is, there should be substantiation of such purchase of vehicle. This is done by showing documentary evidence such as official receipts, specific vehicle number, total price of the depreciable asset, and direct connection or relation to the development, management, operation, and or conduct of trade or business or profession. Next would be only one vehicle for land transport is allowed for the use of an official or employee wherein the value should not exceed 2,400,000 pesos. Third is depreciation on yachts, helicopters, airplanes, and or aircraft and land vehicles exceeding 2.4 million are not allowed unless it could be considered as the main line of business. So to demonstrate, let's go to our first illustrative problem. At the beginning of 2021, a manufacturing company acquired a vehicle worth 2.4 million. The estimated useful life of the vehicle is 5 years with a salvage value of 800,000. How much is the allowed depreciation expense in the year for tax purposes? To compute 2.4 million less the salvage value of 800,000, the depreciable amount is 1.8 million. Then divide it by the estimated useful life of 5 years. Therefore, the allowed depreciation for the year is 320,000. In our next illustration, let's say the same corporation bought a different type of vehicle with an acquisition cost of 5 million and an estimated useful life of 5 years and salvage value of 1.9 million. Now, based from the Revenue Regulations 12-2012, only passenger vehicles that do not exceed 2.4 million are allowed in connection to claiming related depreciation. Therefore, the allowed depreciation expense for tax deduction purposes is 0. So any vehicle that does not conform to Revenue Regulation 12-2012 shall be referred to as non-depreciable vehicle and are further classified as capital assets. It follows that any maintenance expense related to non-depreciable vehicles are disallowed. In connection thereto, any input taxes related to the purchase and maintenance expense of non-depreciable vehicles are also disallowed. And that's it. So if you found this video very helpful, give it a thumbs up and make sure to subscribe because it helps me create more videos like this. So this is Gerard. Have a great day.